The Hong Kong Stock Exchange is the operator of Hong Kong's central securities marketplace and the frontline regulator of its listed companies. It carries out that regulation in accordance with the listing rules. The stock exchange's recent consultations on listing regulation, the new board, and the review of the growth enterprise market have aroused heated debate in the market. In this presentation, Ms. Bonnie Chan, partner at Davis Polk Waldwell, discusses the impact these consultations will have on Hong Kong's competitiveness as a fundraising hub.
Good afternoon, everyone. It's my pleasure to be back again. Last year I was here talking about corporate governance, and today I'm going to talk about our stock market. If you have read some of the reports that was published by the Financial Services Development Council, you would realize that as an IPO market, Hong Kong has been the world's #1 for 5 times in the last 8 years. So that's quite an achievement. So that highlights how successful our stock market is. But for those of you who have been following the news, you would have actually read sometime last year there was a big debate in the market. And the debate was about this joint consultation by the Hong Kong Stock Exchange and the SFC about how to revise the regulatory structure. In fact, it was so controversial that people describe it as a power struggle between the stock exchange and the SFC. So what exactly happened, and how did we get to a situation where Hong Kong has actually 2 securities regulators, right? Both the Hong Kong Stock Exchange and the SFC. So I'm going to take you back to a bit of history. In 1973, there was this piece of law called the Stock Exchange Control Ordinance. At the time, Hong Kong actually had 4 stock exchanges, so not 1, but 4. Then in 1980, the Stock Exchanges Unification Ordinance actually created what is now the Hong Kong Stock Exchange. And that's why it's called OUHK, because there are a combination of 4 exchanges. And that was how long ago our stock market dated back. So the current structure we have was largely created at the time. In 2000s, there was a further unification of the Hong Kong Stock Exchange, the Futures Exchange, and their respective clearing companies. So each exchange has their own clearing companies. And the other very significant event, which happens in 2000, was that Hong Kong Stock Exchange itself became a for-profit company listed on its own board. So what happened next is in 2003, there was the enactment of the SFO, the Securities and Futures Ordinance, and that forms the basis of the securities regulatory structure in Hong Kong. Now, some of you might have already noticed a problem when I said earlier that in 2000, the stock exchange itself became a listed company. So you may ask, you are a for-profit company, you're listed, so your main objective will be to make more money, invite more companies to list in Hong Kong. So there's an incentive to just welcome good companies, bad companies, not so good companies. I want to maximize profit. How does that actually reconcile with the fact that they are also the regulator? So you are the regulator, you're supposed to be watching out for bad apples, but you want to maximize profits. These 2 concepts contradict one another. And that was the reason why the creation of the SFC and the enactment of the SFO, so that you have a structure where there is some inbuilt check and balances. Here, as you can see, as part of the legislative exercise, there was a creation of what is called the Securities and Futures Stock Market Listing Rules. And there's an MOU, which was signed between the SFC and the Hong Kong Stock Exchange. So they were like, okay, we're both going to regulate, and we are signing an MOU to divide up the work. So, you do some parts of regulation, I'll do some part of regulation. So that was the background. So you may ask, okay, so fine, right? These 2 regulators sign an MOU, they know what's happening, so why do we need to keep rethinking about our stock market? Last time, actually, someone took a very holistic review of this structure, and here I refer to a 3-tier market structure, and the 3-tier being the government, FSTB, the SFC, and the Hong Kong Stock Exchange, was in 2002. Now, what happened that year? There was the penny stock incident. Who has heard about the Xin Gu Sikin penny stock incident? Some of you. So what happened that time is Apparently, the Hong Kong Stock Exchange announced a consultation paper. They say, well, we noticed that some of the companies trading on the stock market, their stock price is so small. They propose that they should be delisting these companies whose stock price was below a certain point. And of course, the moment that this consultation paper went out, it sparked off a panic. Investors were saying, oh, my stock is not quite penny, it's right above the penny, but if I don't sell now and the stock went down, then my investment could just go down the toilet, right? So they say, oh, everyone panicked, everyone sold out, and caused the shares to spiral downwards even more quickly. As a result, some senior management members of the stock exchange had to resign. But the government said, oh, okay, maybe there's something wrong with the regulation. Why don't we commission a report and do an investigation and see what the problem is? So this called PIPSI report of the Panel of Inquiry on the Penny Stocks Incident, was published. And they pointed out a number of problems. First of all, they believed that the Hong Kong Stock Exchange at the time was deficient in terms of their understanding and their handling of market sentiment. That's pretty critical. They also believed that Hong Kong Stock Exchange's mode of conducting consultation is not very good. There's a lack of market experience. But more importantly, they pointed out two conspicuous problems. First of all, as I mentioned earlier, this inherent conflict of interest with the Hong Kong Stock Exchange as both the regulator and a for-profit company. And this problem continues to haunt the exchange even until now. And also the failure to engage the listing committee. So at the time, there's already the listing committee, 上市委員會, which is a 28-member committee consisting of people from all walks of life, academics, bankers, lawyers, etc. And the stock exchange didn't really consult them adequately before they put out that consultation paper. So that was the major findings of that report. That was one reason why people keep reminding themselves Hong Kong Stock Exchange has this conflict, right? We need to fix it one day. Also, over the years, the exchange itself has gone through some what I call bumpy patches. Earlier this year, you would remember there was a lot of complaints about the quality of listed company perceived to be deteriorating. You would have heard the term about 楼千股. There's a lot of 楼千股 trying to trick money out of investors' pockets. Also a failure to capture business opportunities on the other side. 2014, when Alibaba tried to come to list in Hong Kong, eventually they didn't, because they did not succeed in getting what they wanted in terms of a dual-class voting structure. And they ended up listing in the US. That is seen as a big failure in terms of capturing a business opportunity, because some of you may know the daily trading volume of Alibaba as a stock is actually equal to 20% of Hong Kong's daily trading. I mean, they are just very liquid. And other complaints such as over-regulation in some areas and under-regulation in other areas. So that's another reason why people say, well, is our stock market being regulated properly? So as a result, this consultation, which I mentioned earlier, came out in 2016 in June. And it took them a long time to conclude. It was concluded only earlier this year. So what were the proposals? So first of all, there was this proposal about setting up a new listing regulatory committee to approve listings with suitability for listing concerns, novel issues, etc. This committee, I didn't put it on this slide, but essentially will be made up by equal members from the stock exchange and the SFC. So the SFC, from a backline regulator, decided to be more involved. The stock exchange is supposed to be the frontline regulator. Now, the SFC is trying to get involved in this regulatory committee. They also proposed to set up a listing policy committee. Again, this committee to come up with policy initiative. Again, that will be staffed by members of the SFC as well as listing committee and the stock exchange. So I think it's fair to say that through these two committees, the SFC is trying to get more involved in the day-to-day regulation of the stock market. But what happened? What happened in the end is that these proposals didn't go through. There was a big debate in the market. There were even people organizing protests, demonstration, a lot of lobbying. And they didn't want the SFC to take over or be more actively regulating the market. At the end, the listing regulatory committee was set aside, or it didn't go through. And the Listing Policy Committee was changed to a panel which has an advisory power, but no powers to actually set policies. So this was reported in the press as SFC losing the fight, SFC backing down. However, it's not as easy as that. While they didn't gain more power through the establishment of those two committees, they came out and say, well, look, what we're going to do now going forward is that we are going to take a front-end, real-time enforcement approach. So if someone were to put in a listing application, the SFC is going to step in and see if there are any policy concerns, what they call SMLR issues, securities and futures stock market listing rule issues, essentially suitability, policy, etc. And if we find there are any issues, we are going to step forward and take very strong enforcement action and intervene. So you would have read recently that some of the listing applications were being essentially asked to stop. You would see in the headlines, 證監會叫停 whatever 新股. That's what they're doing. They're taking this front-end approach. So the question is, if I ask you now, do you want Hong Kong to have a super regulator, meaning that instead of having the SFC and the stock exchange both regulating and each trying to divvy up and someone taking a back line, someone taking a front line, why don't we just have one? Why don't we just have a powerful one and they will be in charge of everything? Or the other approach is, why don't we just let the Hong Kong Stock Exchange do it all? They know the market better. They are a listed company themselves. They have been the frontline regulator for all these years. These two choices, which one is better? There is, in fact, still, up till now, and I can promise you this will continue for a long time, this debate about how we should pick between those two options. Of course, there is one line of thinking which is, again, focused on this conflict of interest point I mentioned earlier. And they say, well, you really shouldn't ask the Hong Kong Stock Exchange to run the market. You should instead have what is called a Hong Kong Listing Authority, right? They are totally not biased, they don't have conflict of interest, and they should be only responsible for regulating. That sounds like something of a good idea. However, we need to think about what the goals of our market really are. Is it really just good regulation? Do we need to think about things like productivity, competitiveness? So the SFC apparently did, when they considered the Alibaba application, they try to stop them from coming because they believe that a dual class structure is not good corporate governance. So that is a very good decision if you think about quality, good corporate governance. But is it hurting Hong Kong's competitiveness? It's fine if you don't list them, they will go elsewhere to the US market. And that's potentially costing us a lot of trading volume a day, which means jobs, etc. So there is another line of thought, which is that, well, we should really strike a balance. Yes, you can have tight regulation, but that would involve a sacrifice, which is short-term stagnation. Regulation alone wouldn't take us very far. Regulation has to be done hand in hand with market development. So these are the questions which is being asked, or is continually being asked. Some people actually think, well, it's not who the regulators is, right? It's the rules. If you don't have good rules, then it doesn't really matter whether you ask the stock exchange or the SFC to enforce them or to implement them, it will be equally bad. So if you take a look at Hong Kong's problem, or the fundamental problems haunting the Hong Kong stock market, there are quite a number. So the liquidity problem, you have a lot of stock which doesn't really trade, they're just listed. Price distortions, low valuations, and reliance on the China pipeline. In Hong Kong right now, the whole stock market, 60% of market capitalization belongs to mainland Chinese companies. So we're rather one-sided. I didn't, of course, provide an answer to what is best. I think it's for you guys to decide. But anyways, let me take you through a few recent regulatory initiatives, what we're doing to plan for the future, to give you a flavor of where we're headed. So first of all, and I think this is a good initiative, is a closer scrutiny on gem IPOs. So here, the exchange has issued some new package, basically a joint statement on GEM IPOs and some guidelines they issued to investment banks about GEM stocks. And why did they do this? Let's look at the statistics. They said in 2015, average first day price gain for GEM board stocks, the first day they're listed, is 743%, 7 times. Now you're going to say, well, I shouldn't have my main board Sungu, right? I should have just invested in GEM companies. I'm going to make 700% gain. That's not bad. Whereas main board is an average of 5%. Well, it's actually not very good, right? Basically means that it's totally mispriced. If you are a company selling your stock and the stock price goes up 7 times, that means you've sold your stock very cheaply. You could have fetched a higher price. Price distortions. However, half of the top 10 first-day gainers on GEM had their share price plunged by 90% within a month. So the lesson is that you should sell as quickly as possible. Well, that means what likely could have happened is that the stock price went up. All the retail people saw that and say, wow, right, this is a good stock. I'll chase the stock. I'll buy in. And then, of course, when they bought at this high level, they might have a paper gain for a short while, but within a month, it will go all the way back down. That was one big problem with our GEM market. And therefore, as a result, the SFC and the stock exchange came out and said we need to regulate them more. First of all, what they found is that a lot of times the allocation of the IPO is not done very well, and that they essentially just put the shares in a very small number of places. So that gives rise to a lot of manipulation. We hear the term zongga a lot. You just park the shares with a few people and they will just trade within one another to create an impression that the stock is going up. And that's just to lure retail investors to come in. This is not obviously conducive to forming an orderly market. So the SFC's way to handle this problem is to say, going forward, sponsors, you have the duty to ensure the overall integrity. And therefore, when you do these GEM placings, I want you to basically keep records about all these orders you receive when you build the book, etc. And the SFC will take action against these sponsors, applicants, underwriters who fail to follow their own policies. So that was one big thing that the exchange is doing, which I commend. It's a good initiative. The other thing is, of course, they also noticed that a lot of these GEM listings really are not for the purpose of raising capital. It's for the purpose of what is called shell creation, 啤殼. So what is shell creation? Shell creation is essentially that you apply for a listing, but shortly after the listing, you're going to basically drain all the assets, all the business out of that, create an empty shell, a listing status, and sell that. For a while, the shell price has gone up so much that I've never really see a price list anywhere, but a main board shell could be sold for about 700 to 900 million Hong Kong dollars, and even a GEM shell is $300 million. Gives people a lot of incentive to just bring any business they can find to create a shell. Since I used to work at the stock exchange, I asked them, so what is the latest trend? They said, construction companies. This is the typical business you can create a shell with because it's very easy to wash it out. So all you need to do is you have a company with some cash flow, some profit, you list them, and then a construction company can just stop taking new projects. Then 3 years later, there'll be nothing left. They don't even have machines because they rent the machines. They don't have employees because they just hire contractors. So it's quite easy to create a shell. And I said, oh, wow, if this trend continues, then Hong Kong will run out of construction companies to list. They said, oh, yeah, it's run out already. Now we are listing construction companies from Macau, Singapore, Malaysia. So these people just keep finding these small businesses to create shells with. Not a very good situation. These are just two examples showing how the SFC action, or how they have stepped up action, and these couple of, this company in particular, they were asked to stop in the middle of trying to do a GEM IPO. Okay, this one is interesting, and you would have heard about this initiative about the creation of a new board. The stock exchange earlier this year in June published a concept paper proposing to create what is called 創新版, which will allow listing applicants to come to Hong Kong even though they may have what is called a weighted voting right structure, the dual class structure. Now, this is sort of a response to losing Alibaba, if you may. This is still a consultation which has not concluded. The major topic which was being discussed by this paper was whether or not a company like Alibaba were to come in the future to Hong Kong to list, would Hong Kong allow it? Now, and maybe I should do a little experiment here. Who thinks that it's a good thing having dual class 同股不同權, dual class company listed in Hong Kong? Who think it is a good idea? Okay, a few hands. Okay, let me try to ask it in a different way. Tencent, 騰訊, it's a good stock. If I tell you that you can own Tencent stock, and I'm going to even let you have a 10% discount, but the condition is that you cannot vote as a shareholder. But you will enjoy 10% discount on the Tencent stock, and you can buy it now. Who's going to buy? How about 20% discount? Right, more hands. Okay. What I'm trying to show you is actually investors can price in this so-called bad corporate governance, right? Yes, it could be bad corporate governance, but if you're telling me that you are going to adjust the price, I may still want to invest in this company. So that's why I think this debate should not be simply about what is good or bad. I think it should be about investor choice. I mean, there were a lot of hands. I mean, for those of you in the front, when I asked 20%, there were a lot of hands. If I asked 50%, maybe the whole room is going to raise their hands. Of course, I picked Tencent. It could be another company. Anyway, so we're going to all wait for this consultation results to come out. The other one that is being consulted at the moment is the GEM and main board listing rules. Because of those many problems on the GEM board, the regulators wanted to review the positioning of GEM. And essentially, they want to make sure that they curb the recent scandals. What they want to do is to reposition GEM so that it's no longer a stepping stone to the main board. That means once you're a GEM company, if you've grown and you want to move yourself to the main board, you can do it, but you need to jump through all the hurdles again. You need to prepare a prospectus, you need to appoint a sponsor, they need to do diligence. They also want to tighten the GEM entry criteria. So at the moment, it's operating cash flow requirement of $20 million for 2 years. They're going to increase it to 30. It's still not a lot, actually. And a minimum market capitalization of $150 million. And they're going to extend the lockup so that it's, instead of 6 months plus 6 months, they're going to increase it to a 2-year lockup. So that's another thing that we're doing. They also want to make sure that those things I mentioned earlier is to try to prevent bad companies from even getting listed. The other thing that they're trying to do is to make sure that if there are bad companies, we kick them out quickly. So they have this consultation paper about delisting as well. If you have listed, but you're not really doing well, the exchange can delist you quickly. And the grounds of delisting are listed here. The material breach of listing rules, if you fail to maintain a public float, if you don't have sufficient assets or operation, or you're just simply not suitable because you engage in some questionable behavior, then you can be kicked out and it will be accelerated. These are details, but essentially they want to collapse the current process, which takes many stages before a company can be delisted. That's really all I have, and I think time is running out in any event. I welcome you to actively participate. Thank you.